Well, holy Hannah, here it is, January 1st, 2018. We're back in the recording studio once again. Wouldn't you know, the IRS, in their infinite wisdom of trying to make this stuff easy, makes it more complex because they keep changing information on us. So, that being said, we're going to rehammer this presentation for you, covering all the new updates that they've done, along by taking some of the stuff out that is no longer applicable, since you can no longer prepay your property taxes for 2018. Those that did, hopefully you didn't incur too many long lines. Those that did not, it's okay. We'll give you more opportunities to find ways to save on your taxes throughout the year as well. So welcome once again. I am Matt Deal of Deals Accounting Service. This is the 2018 Tax Cuts and Jobs Act bill, making sense for the average American. Hopefully you are in a warm place today in Minnesota. It is negative, and it makes for a little weary on the bones when it is this cold. But nonetheless, warm up next to the fireplace, grab yourself something to take notes on, and welcome to the meeting. A little bit about the firm first, as I'm just trying to clear my cobwebs here from last night's festivities. This firm is established back in 1965, a second generation. I cannot believe I'm saying that, but we are a second generation family firm. That is absolutely awesome. Also means that our clients, just like you, are making sure that we're able to stay in business as long as we have. We specialize in small business and individual taxation, along with payroll compliance, full payroll services, bookkeeping, tax planning, retirement services offered through third-party licensed brokers, and service in all 50 states. We have 3 convenient offices in the Twin Cities, including Lino Lakes, New Brighton, and Elk River. Virtual offices open 24 hours a day, and we do offer travel to any location inside the United States, preferably sunny, warm, so I have no problem for clients reaching out to us in Miami. I will go there. I have no problem doing that. There is our contact information down below. Here's the main New Brighton office address here. The website, dealsaccounting.com, and reach us at 952-33-DEAL, which is 952-333-4345. Before I continue on, got to get this disclosure in. I better crack open my can of pop and my thing of water here just to make sure we've got enough oomph to get us through the rest of today's presentation. Deals Accounting Service, Inc. is providing this information as a means of education and discussion points. Any typos, erroneous, or outdated information is not the responsibility of Deals Accounting Service, Inc. The viewer should not rely on this information solely as definitive tax advice. Deals Accounting Service, Inc. is not responsible for any direct or indirect repercussions as a result from this presentation. Please, as always, consult with your qualified tax professional. Every time I go through that, I keep thinking of the old announcement they'd make inside the Metrodome. It'd say, no smoking in the Metrodome. And everybody would go crazy. For some reason, the disclosure page makes me think of just that. Okay, so now they're through that. Let's get to the meat and potatoes of this for the third or fourth time. I've lost count. We're going to break this down into first individual taxation changes, and then we'll round it out with business taxation changes thereafter as well. On the individual side, the first thing we're going to take a look at here is tax brackets. In my second presentation, I did a horrible job of explaining this one key element at the time, and we had to bounce back the screens, and it sounded like yours truly had no idea how to use a mouse or a computer for that point. So we'll try to make it look a little bit more conscientious for you right now. The first bracket we are looking at is the single taxpayers. And I will say also, keep in mind that all of these, with the exception of a few elements I'm going to discuss, are tax law changes that occur starting today, January 1st, 2018, and run through 2025. After that, we are not certain what will happen of it, and who knows, you might also see somebody else come in office in a few 2 or 6 years from a different political persuasion and decides to unhook the entire deal, bring us back to where we were currently. But as of right now, for single taxpayers before the new tax reform, this is how the tax broke out for those single taxpayers. 7 tax categories were included, the highest one of 39.6%. The one thing we want to make mention here when we start talking about taxation and individual levels is how we compute this taxable income, because I will say even for our clients, there's a misnomer as we start going through this in terms of how tax is computed, and somebody says, I'm in the 25% tax bracket, I'm getting killed. Well, keep in mind here that the 25% tax bracket means that for your income for a single filer, between $38,701 and $93,700, that portion is taxed at 25%. The portion before that between $95,26 and $38,700, and that is not 38. Wow, that is a typo of erroneous proportions, but I'm not going to fix it now. That portion between $95,26 and $38,700 is taxed at 15%, and then the base amount of $0 to $95,25 was taxed at 10%. So we got 10% tax here, plus the 15% tax here, plus every dollar at the 25%. So when we start talking strategies in terms of managing tax footprint, when we start talking about lowering your taxable income, it's always taking the money off the highest bracket first. So if all of a sudden we can save $30,000 in the 25% tax bracket, that is the savings of $30,000 times 0.25, not factoring anything for 15 or 10 because those are lower tax breaks. So there's a little strategy 101 that we want to work with. So this again is the old bracket. Here is the way that the new single taxpayer bracket worked as we look in this year. So again, we've got still 7 brackets. However, you'll notice the top bracket ends at 37, so it drops down 2%. With the exception of the 35% bracket, everything else dropped. Some of these dropped considerably by 3%, some to 2%, but again, you're still seeing a wide. So before, with 38.7 was taxed at the 15%, now 38.7 is being taxed at 12%. So you're saving 3% tax income on the backside. On the meat and the potatoes, where we see a lot of Americans sitting for the 25% bracket, anywhere between 38.701 and 82.5, so they dropped that top line down a little bit, but again, it's still at 22%. Even if you were at 93.7, you're still paying 1% less tax than what you were before. So I will say for the average American, this is going to impact you in terms of your overall tax and how much you end up paying to the federal government. Keep in mind, these tax rates have nothing to do with your state or local taxes. That's a separate, complete discussion that you need to bring up with your state authorities and your local representatives. On our head of household taxpayers. And I'm just cleaning something out of the way there. Here's the way that the original bill was for 2018 for head of household. And as we adjusted the new numbers again, 39.6, the top line drops down to 37. There is a thing that we should note as well, too, that the new tax law eliminates the discrepancy in income threshold between a head of household filer and a single individual filer for all income subject to the 24 rate and above. So before, a head of household seemed to do much better in the higher tax brackets because, well, the federal government said, obviously, you've got something you're carrying for, so we will reduce your federal tax income. Now they've kind of blended all these numbers together, identical at 24 up to 37 for both head of household and single tax filers. For the married filing joint, again, we see some numbers dropping down here, even the top line number 39.6, again, still dropping down to 37. But again, you'll notice in the meat and the potatoes here that we see most of our clients in is at this 25% bracket. Now that bracket is 77,401 to 165, and that tax dropped from 25 down to 22%. And then our married filing separate. Yeah, there is a category for this. Sometimes it does make sense if you are trying to reduce the amount of obligation to your student loan interest. This is what will do that, because most people then say, I want to pay a lower payment to my student loan interest, but I can't include my spouse's income. This is sometimes where a married filing separate return may work. In the past, also because of the marriage penalty, there are sometimes that people would opt to do a married filing separate. And sometimes it worked to your benefit, sometimes it did not. The other thing to keep a note here is that with the new tax bill, it eliminates that so-called marriage penalty in all but the highest tax brackets. So thus also would remove much of the disadvantage the married filing separate filing status had. And we did see this a lot where people would say, I've got to file this and I know I'm going to end up paying $2,000 more in taxes. But if I pay my student loan for the next 8 years, I'm going to save $60,000 because I'm going to pay the rest of it off. Knock on wood, if they continue to do that, we'll find that out. But again, this eliminates that marriage penalty with a married filing and separate return. So let's take a look now at the standard deductions and personal exemptions for the individual taxpayer. The key thing to note here is that all of a sudden, compared to the old code, we're jumping up almost double in some circumstances to the new numbers. So, for example, if you were a single filer last year, your standard deduction was $6,500. That jumps now to $12,000. So if you could not itemize before, you're going to get roughly another $5,500 of exemption, or I should say of deduction on your as opposed to working with your Sched A. Head of household moves from $9,550 to $18,000. Married filing joint, the big bump here from 13 up to 24, and a married filing separate, they're taking exactly half that amount. So married filing separate, each person can claim $12,000. Keep in mind that with regards to that married filing separate, the still rule applies that if one person is going to itemize, the other has to itemize. So at least now you'll get double that benefit if you're going to say, well, we can't itemize because we don't have enough to go over. Dilly, we're going to take the standard $12,000 and call it a day. The additional standard deduction amounts for the elderly and the blind were retained in the new tax bill. So if you are elderly or blind, there is some additional standard deduction you'll get on top of this as well. These amounts will also be adjusted for inflation for tax years beginning after December 31st, 2018, and is scheduled to sunset on December 31st, 2025. Again, you never know what's going to happen in the future, so this is the only thing that we can tell you as of today. The one big caveat to make here, and you'll see it on your screen, this personal exemption of $4,150 that we had up to this point per individual in the tax return has been eliminated. So if you are a married filing joint couple with 2 children, not only would you take your standard deduction, last year it would be for 18 without the adjustment, it'd be $13,000. Plus you would get $4,150 per person for 4 people. So I'm going to grab my calculator, $4,150 times 4. That means you get an additional $16,600 in reduction to your taxable income plus the $13,000 you would have gotten for your standard deduction. You're now up to $29,600. So you notice this $29,600 is greater than the $24,000. So the big question is, where is the tax savings if we're going to be paying more taxable income? We'll talk about that in a minute, but one of those elements we talked about before is the fact that every tax bracket has gone down at least by 2%, in some cases up to 3%. So you will be paying less taxable income to the federal government, but also we're going to show you the other big caveat that this goes into in the future. So even if you can't itemize and you can't take your personal exemptions, it still should benefit you with children. We'll take a look at that in just a little bit. Okay, so we're going to look at the Schedule A itemization changes. So if you have a Schedule A in front of you, which if you don't, that's okay. I've got one here. This was provided by Forbes. A great article they did talking about how the new Schedule A is going to look compared to the old one. We'll kind of go through this with some brief highlight points here. The first one is on Section 1 for medical and dental expenses. Prior to this year, you had to hit 10% of your adjusted gross income before you could take any medical expenses. So if you have a taxpayer with an adjusted gross income of $100,000 and you take 10% of the amount, you're going to get $10,000. $10,000 is the floor, so if you do not have more than $10,000 of medical expenses, you do not get any credit. If you come up with $10,001 of medical expense, you get to carry one big dollar over and under this amount because you eat the rest of it to the floor. For 2017 and 2018 alone, those 2 years, they brought the 10% down to 7.5% of your AGI. So 7.5% is what we use for our floor this year and in 18, and that's it. And then they'll move back to the 10%, I believe, after that. And the subsection 2 for taxes you paid for state and local taxes, which are also called SALT, state and local taxes. Boy, the government loves to use these goofy acronyms. Half the time they make sense, but they just sound dumb. This is one of them. So anyway, with regards to our SALT, bear with me a second here. I'm just pulling a couple of things down. With regards to the SALT, it now says that for all of your combined state withholdings on your W-2, real estate taxes paid, personal property taxes paid, any other state or local taxes, or any general sales taxes, this amount is capped at $10,000. So if you look at your current Schedule A and you look at Box 9, if that amount is greater than $10,000, you would lose the difference between that and the $10,000 for itemization purposes. Going down here as well, too, on number 4, with regards to mortgage interest. The interest paid on home equity loans, first of all, is no longer considered a deductible expense. So if you took that HELOC out, or if you're going to take a home equity line of credit out, assuming that, at least I'll get to write off the mortgage interest. No. The government says you cannot do that. They say that is no longer a deductible expense. Only your primary mortgage is the only thing you can take. And that primary mortgage amount deductible has been lowered to $750,000. So if you have a $1 million mortgage, you can only take the expense related to the first $750,000 on new mortgages. So we've got that going on. Also, charitable contributions. We're going to talk about this on the next page, but there are some changes to the charitable contributions as well. Casualty and theft losses. Before you could deduct any casualty and theft losses you incurred over an extent to what you received from your insurance carrier or from anybody else related to the casualty and theft, you could take it on line 20. That is no longer available unless you are in a declared federal disaster area. So if you are not in a federal disaster area, don't even think about writing casualty and theft losses off because you can't. Also, the big element that's happening for a lot of taxpayers is all miscellaneous deductions, unreimbursed job expenses, tax prep fees, bond management fees, investment fees, anything related to this such is no longer in. This whole section is not even going to be, I don't think, in the new Schedule A. So if you are an employee and you have a bunch of out-of-pocket medical expenses or good grief, it is New Year's Day, isn't it? I can tell. If you are having any out-of-pocket unreimbursed job expenses, if you're a flight attendant, if you are a pilot for that matter, if you drive over-the-road truck, if you're a salesperson where you put a lot of your own expenses out, you no longer get any of those expenses. Congratulations. So that's kind of the breakdown, at least, of the new Schedule A and how it may impact most of you. If you take a look at your Schedule A number, if it's not over $24,000, if you're a married couple, for example, you will not be itemizing next year. If you're at $26,000, but all of a sudden in your subsection 3, you've also got $16,000. Remember, we're capped at 10, so you're losing 6 there. You probably won't be able to itemize anymore. It is what it is. They're trying to simplify some of the tax code. Take it for what it's worth, folks. So that's the itemized deductions. We are kind of talking a little bit more about this here on the next page as well. It talks about for medical expenses, again, Florida just back to 7.5 for 2017-2018. State and local taxes only subject to a maximum amount of $10,000. Mortgage interest paid on home equity loans no longer deductible on new mortgages, and also mortgage amounts deductible only to $750,000. With regards to mortgage interest debt incurred before December 15th of 17, they are not affected by this reduction and therefore are grandfathered in. Any debt incurred before December 15th, 2017, but refinanced later would continue to be covered by the current law to the extent of the amount the debt does not exceed the amount refinanced. For tax years after December 31st of 2025, the $1 million limitation would apply. So again, $750,000 through 2025, bump it up to $1 million after that. Also keep in mind, there are no more deductions for moving expenses. So if you had moving expenses, that would go on page 1 of your 1040 as an adjustment to your taxable income. No longer applicable, however, the targeted rules providing income exclusions to a member of the U.S. Armed Forces would still be retained. For charitable contributions in certain circumstances, percentage limitations increase from 50 to 60%. Taxpayers are no longer able to deduct payments made to colleges in exchange for athletic tickets or seating rights at a stadium. So if you are an alumni and you are paying a fee into whatever school, and for that you get rights to buy tickets to your favorite game, whether it be football, hockey, whatnot, you are no longer able to take those payments as a deduction as a charitable contributions. Keep in mind, again, casualty and theft losses no longer allowed unless you are in a federally declared disaster area. No more unreimbursed job expenses. There are no more provisions I should say they have updated the language. That's a better way to put this with regards to gambling losses. And the IRS now says losses from wagering transactions is going to be further clarified that these only apply to actual costs of wagers incurred by an individual. So, for example, in the past, if you had traveling from a casino, you could potentially include some of those expenses as part of your losses. Those are not allowed anymore. So it is now just hunkered down to the actual wagering costs themselves. Keep in mind that for those of you out there that have income that you made from gambling that you want to offset, first of all, make sure that you're still able to go over the Schedule A itemization for the standard deductions, because if not, it doesn't matter anyway. And if you do, the IRS says that you better be keeping gambling logs, so your wagering logs, you've got to keep those. It's a pretty detailed thing. They want you to keep it by track in terms of event or type. So if you are at a slot machine, they want you to keep track of how you're doing on that individual slot. So they don't want just the annual or the nightly recap. They want it over by time. So if you go all of a sudden you play a table for poker and you stay on that table, that's one thing. But if you move around from machine to machine, they're going to want you to keep track of that somehow. Now, I'm told most people that are gamblers like that, they get those the frequent rewards cards, which keep track of all their playing activity. Normally, I've found that does work with regards to audits. But again, be sure work with your tax professional before you start doing anything crazy like this, because we don't want to see you get an audit trouble and then all of a sudden you're calling up your accountant saying, hey, what the heck is going on? IRS says they're not including this year. That is what it is, but that's the way we go from here. Okay, also for the child tax credits, I told you before there's a couple ways that individuals are going to maximize taxes this year that will benefit them in a better position than what it was in the old 2018 law. And here it is with regard to the child tax credit. Through the year 2025, this credit increases from $1,000 per child to $2,000 per child. So they are doubling the tax credit. The AGI also, and this is a key one, so listen up if you're also cleaning your floors at the same time you're listening to me today. The phase-out amount has been increased. Before, if you were a married filing joint and you had $110,000 of income, you started losing parts of your child tax credits in blocks of $50. That amount for a married filing joint couple moves up to $400,000. I can tell you that we spend a fair amount of time in the office here every year trying to help work with our clients to get their taxable income below 110 so they could maximize their child tax credit. At least we don't have to spend so much time worrying about that, because $400,000 now, many more Americans will qualify for the child tax credit. Thanks to Mr. Rubio, my understanding is for that one. He's the one that was instrumental in making sure that took place before he signed off on the bill. Also, for the AGI level for child tax phase out for single filer moves from $75,000 to $200,000. Congratulations, everybody that has not been able to get child tax credit for a while. You are now able to do that, hopefully, starting in 2018. Also, a temporary non-refundable credit of $500 would be made available for qualifying dependents other than qualifying children. So if you've got Uncle Remus that is a qualified dependent of yours, you take care of him, he resides with you, you provide more than 50% of his support, he resides in your residence for more than 50% of the overnights plus 1 day, he could be considered a qualifying dependent. He would potentially give you a non-refundable credit of $500. Non-refundable means that if you have no taxable income, you cannot get the $500 as a refund back to you. But if you have tax income, this will drop your taxable income that you owe to the federal government by $500. Other thing to keep in mind is that for the new $2,000 child tax credit, the IRS does require a valid Social Security number for each qualifying child. This does not apply to the $500 non-refundable credit, however. So if Uncle Remus does not have a valid Social Security number, he could qualify for the $500 non-refundable credit. If you have a qualifying child that does not have a valid Social Security number, you could still get them eligible to at least give you the $500 non-refundable credit. But without the Social Security number, they are not able to take a $2,000 child tax credit for that. In addition, for the child tax credit, $1,400 of that could be refundable. So again, if you have very low income, so you have no taxable income, and you have 3 children, each child will give you $1,400 that you can get as a refund back from the government. The other $600 you lose, but hey, that number is still up from last year. Also, the earned income threshold for the refundable child tax credit is lowered from $3,000 under the current law to now the new law of $2,500, but this threshold is not going to be indexed for inflation, so it will always remain at $2,500. So there you go with regards to the child tax credit, some of the discussion points there. Again, for most Americans that have children that may not have been able to qualify before, most likely you are going to get this, and now you're going to get it at double the amount before. If this means that you've got a reason to celebrate and have more children this year, congratulations to you. Welcome to the fracas, and thanks for adding to the population numbers. We need all the people we can get to keep kicking into Social Security. That's a whole other discussion for another day. Anyway, for also individual taxation changes as it relates to business income and losses for individuals. Let's go a little deep dive into this. Capital gains and qualified dividends, they are still same as before. You've got a maximum rate of 20% or 15% with higher rates for gains from collectibles and unrecaptured depreciation. Also, in addition, the current 3.8% net investment income still remains in effect under the new tax bill, so we didn't do anything with regards to that. Capital gains, as you may or may not know, is if you have an asset that you bought, like stock, or a vehicle, or something that you had an asset on for a business, and you sold it, you made more money than what it was worth on the books. Those are called capital gains, and depending upon what your income threshold's at, it determines how much tax you pay on that capital gain. So in the example of married taxpayers, the 15% break point is at $77,200, and the 20% break point is at $479. So if you have capital gains of $77,300, because it's above this break point of 15%, you'll pay 15% tax on that cap gains. And if you have something at $480,000, now it's taxed at 20% because you've hit the 20% break point. With regards to head of household filers, the 15% break point is at $51,700. The 20% break point is at $452,400. And for all other filers, the 15% break point is at $38,600. The 20% break point falls at $425,800. Other taxation issues with regards to individuals. The tax on a child's net unearned income, also known as the kiddie tax, is now simplified, effectively applying an ordinary and capital gains rates applicable to trusts and estates to that net unearned income of the child. So in the past, depending upon how much income the child had, sometimes they taxed at the parents' threshold, whatever their tax rate was. Sometimes they didn't tax at all. They're just saying, hey, a child can have unearned income, and we're just going to figure out how much that child is going to pay based upon how much a trust or an estate would have paid on that same amount of unearned income. So a simplification process there for any of you that are running some income through your children of unearned investments, things like that. Also, just this is more of a side note for me to see how crazy the government gets with sometimes their things. The way they determined in past years when they're going to raise the standard deduction rate and determine what the new tax rate is they looked at something called the Consumer Price Index. They would take a look at the CPI to determine how much they're going to move a tax rate one way or another, how much the standard deduction should increase. So now they're using something called change CPI, which takes into account during times of inflation, the consumer's preference to buy a cheaper good out in the market. So instead of buying the Coach handbag, you might buy, and I just realized that's a horrible example because I don't know jack squat about handbags, but let's say we're talking about Beats headphones. During inflation, when somebody says, I don't want to pay $200 for a set of Beats headphones, I'm going to pay $40 for this other pair that I found at Walmart. That's what's considered change CPI, and they will use that method now to determine changes to thresholds like standard deductions and the tax rates. Keep in mind, this change CPI does remain in effect after 2025. So unlike most of the other things that we're talking about here, this is not something that sunsets with all the other bills. This just looks to be the way the federal government is going to start determining how they're going to make this, and they're going to use CPI, change CPI moving forward from this point. Bicycle commuting reimbursements have been suspended for the years of 2018 through 2025. So if you rode a bike to work and your employer gave you credit for that, you no longer will get that qualified reimbursement. The AMT exemption has been temporarily increased to $109,400 for married filing joints. with the phase-out threshold increasing up to $1 million. Married filing separate returns at AMT exemption is increased to $54,700. The phase-out on those folks are $500,000. There's a missing zero. Nice job, Matt. For all other filers, the AMT exemption has been increased up to $70,300. The phase-out threshold happening at $500,000. Amounts from qualified tuition programs under Section 529. If you have a 529 plan, you now can roll that over to an Able account without penalty, provided both the Able and the 529 was owned by the same designated beneficiary. 529 plans, college savings plan, put money in it, it grows. If they take it for qualified expenses, you don't pay any money on the capital gains, yada, yada, yada. So that's our brief discussion on the 529 there. Does not apply to distributions after December 31st, 2025, I should note. Also, combat zone tax benefits are afforded to armed forces members that had performed services in the Sinai Peninsula of Egypt. So if you were in the Sinai Peninsula of Egypt as an armed force member performing active duty, effective June 9th of 2015 and moving forward through 2025, you are now eligible for combat tax zone benefits. The thing that we still have not found out yet is if this requires you to go back and file an amended tax return, or if they're just going to automatically know that because they'd have record of your service duty. My gut instinct tells me probably there's going to be some amendment here required, but I don't know for certain, so don't quote me on this. I'm just spitballing and thinking out loud. Any income resulting from the discharge of student debt due to a death or disability is excluded now. Applied to discharges happening after December 31st, 2017. So we are now in this process. Heaven forbid if somebody out there that you know that possibly you're married to or that you've co-signed a loan for. Well, you know what co-signing is? I'm thinking, I'm not certain. But let's use the example that you've got a spouse that still has student loan interest and student loans and passes away. You do not need to count that as taxable income now. So if they had $30,000 still outstanding, in the old days, the federal government would make you count that as income. Welcome to government. Now at least they're not doing that, but it's a crying shame they did not change this law before. Also, the other new one is now if you have you're sending your child, daughter, granddaughter, whatnot for qualifying higher education expenses. It's now been expanded to include public, private, and religious elementary and secondary schools. So no longer do we just have to use this for post-secondary. We can now use it for elementary and secondary schools that are private, public, or religious in nature. Keep in mind this tax-free distribution amount when used for elementary and secondary is maxed out at $10,000 per student per year. So if you have two students, you can get a total of $20,000, $10,000 for each. During the post-secondary school period, there is no limitations. You can take the full amount because, well, you know how expensive it is to go to school these days. In addition, alimony and separate maintenance payments. As Led Zeppelin once said, alimony pays your rent. Living, loving. She's just a woman, I believe. If you're receiving alimony, you no longer need to include that as income. And if you are paying alimony, you no longer get the deduction of your taxable income. Congratulations. FYI, this is effective for any divorce or separation agreement executed after December 31st, 2018, and for any agreement executed before but modified after that date, if the modification expressly provides that this new provision applies to such modification. A lot of legal mumble-jumble, but this is where you want to start talking to your attorneys. Yep, we got to talk to the attorneys sometimes. They'll bill you by the 10th of an hour. But when you start talking about the fact that this could potentially change a real big tax picture for either taxpayer, good to get them involved just to understand, hey, if we do this, we alter this, is this going to change something around? Oh, and once you know, okay, well, we're not going to go through these in particular order because apparently I didn't sort them correctly. But we had a bunch of questions as we've gone through this that said, hey, what about this? What about that? What about this? Well, normally, if it's not brought up, that means it hasn't been changed. But I thought it'd be good just to go through some of the big highlights to make sure that these elements that people were worried about because you heard them during the news, how they addressed them, and then really what happens is they weren't changed at all. So the two at the bottom here first, for example, If you had adoption assistance programs before, you could include an exclusion amount of $13,570 from your taxable income. That amount has been retained. They were talking about getting rid of that adoption credit, but they did not. That one's still there. Also, educator expenses. As you remember, if you're an educator out there, you can take the first $250,000 of expenses as a reduction of taxable income on page 1 of your 1040. That amount still remains. That there was talks about moving it up to 500. There was also talk about completely eliminating it altogether. So it is staying at 250. I'm sorry. Keep in mind though, that's the only 250 you're going to get because you don't get any more unreimbursed employee expenses. So those teachers and instructors before would take the rest of it on the 2106 or just for unreimbursed job expenses. Since that part is no longer available in the Schedule A, the only thing you're going to get is $250. That's it. But hey, at least they retained something there. Congratulations for you. Okay, the gain of sale on your primary residence. If you sell your primary house, currently if you lived in it 2 out of 5 years and you were a single filer, the first $250,000 of gain you could exclude from income. For a married couple, it was $500,000 of gain. There was talk about changing that time frame from 2 out of 5 to something else. Just want to let you know that the amounts and the time frame stays the same. And as a point of contention, just to bring this up, when we talk about the gain, it's not talking about what you had left in the mortgage you paid. So if you buy a house at $200,000 and then you sell the house for $300,000, you have a gain of $100,000. Whether you're an individual or a married couple, based on these numbers, you don't have to report any income on it whatsoever. If you're buying a house that you're going to live in for 2 out of 5 years and then flip, and so you buy a house for $100,000, you put $300,000 into it, so now your basis is $400,000, and you sell the house for $1 million. You've got $600,000 of capital gains. You get to reduce it either by $250 or $500, depending upon how you're filing. The rest is what you pay capital gains on at that tax rate that we told you before. So it's either 10, 15, or 20%. Again, as always, consult your tax advisor. Make sure you're keeping track of all your receipts and papers if you are having improvements you're making into your primary residence, just so you know exactly what your basis, your real basis is on that property. Also, employer provided housing. There are no limits set for employer provided housing. That stayed the same. Dependent care programs, you can still put up to $5,000 a year as a pre-tax dollar into dependent care benefits. They were talking about getting rid of that. They did not. Also, up to $5,250 of annual employer-provided education expenses. That's still excludable from your gross income. They talked about getting rid of that one, and they did not. For businesses, we'll go through this a little bit more briefer because, first of all, a lot of this does not apply to most people out there because a lot of this specifically relates to a C corporation as opposed to an S corp or an LLC or a partnership. But keep notes: the corporate tax rate for C corps dropped from 35% to a flat tax rate of 21%. Keep in mind this does not distinguish between investment income and business income earned by corporations for purposes of applying the 21% tax rate. If you are a personal service corporation, that corporate tax rate is now limited. Congratulations. A lot of attorneys, sometimes accountants, other people were considered as PSCs. They had to pay a completely different tax rate than everybody else, which I thought was ridiculous, but I'll get off my soapbox now. The 80% dividends received deduction for dividends from 20% owned corporations is now lowered from 80% down to 65%. If the corporation is less than 20% owned, then the 70% dividends is lowered to 50%. And the AMT on net capital gains is repealed. The corporate AMT is repealed altogether. And the net operating loss deduction for any given year has been limited to 80% of taxable income. But this is effective to respect to losses arising beginning after 12/31/17. So for the 2017 filing tax season, the NOL deduction, that limitation does not apply. It just starts in 2018. Also, the Section 179 expensing election will be modified to a maximum of $1 million. This is something they keep bouncing around from year to year. Is it $250,000? Is it $500,000? Most of the taxpayers are like, well, we'd like to buy some stuff, but we don't know how much we could write off. The 179 says, I'm going to buy a widget, whatever that widget is, for $100,000. And you could elect to write the whole $100,000 off in the first year if you wanted to. Obviously, there's nothing to write off in future years, but if you're doing this for a tax strategy, You say, I'm going to take the 179 now. Well, so now you can buy $1 million of widgets and write the whole $1 million off in the same year. Keep in mind that the state tax code may vary slightly. Minnesota, for example, does not allow 179 deductions. So you take it on the federal side, and the state says, well, the hell with you. We're not giving you that kind of tax credit 1 year. You're going to have to add back some of this, and we'll get you that deduction over the next 4 years. So you won't lose it, but you won't get it all in 1 year with respect to the state of Minnesota. So, again, every state is different. Make sure you check with your local state borough. Consult your local tax accountant to talk further on that. The bonus depreciation percentage is increased from 50% to 100% for property acquired and placed in service after September 27, 2017 and before 2017. So you can take some bonus depreciation. This is different than 179, but again, they're moving that up from 50 to 100%. Also, depreciation limitations are increased for passenger automobiles placed in service after 2017. So if you are not claiming the bonus depreciation, which is this point right here, the allowable depreciation you can take is limited to $10,000 in the first year. This is on passenger automobiles placed in service after 2017. So if you bought a car today, first of all, if you did today, I don't know how the hell you would, because I think most auto dealers are closed, but buying a car in 2018 and not taking bonus depreciation, you're limited to $10,000 in year one, $16,000 of depreciation in year two, $9,600 in year three, and every year after that, $5,760 until you finally burn through the rest of that depreciation, or you trade the vehicle in for something new. Congratulations. If you are a farmer, certain machinery and equipment that have been used in farming now has a depreciation recovery period shortened from 7 to 5 years. Again, this is very specific equipment, so be sure to check with your tax professional before making any decisions on if this is applicable and what you should do. The gain or losses arising from the sale, exchange, or other disposition of a self-created patent, invention, model or design, secret formula, or process, they are no longer treated as a sale of a capital asset. So if your brain matter is working wonders for you and you've got some patents or some rights or whatever you've done something new that nobody else has thought about before, you no longer have to consider that a capital asset when you actually sell it. With regards to like-kind exchanges of real property, when we're talking real property in the United States, now is only considered like-kind when you purchase property inside the U.S. You can no longer sell your rental property in Idaho to purchase a property in Barbados. No like-kind exchange allowed. It has to be U.S. to U.S. only. No deduction is allowed for any activity considered entertainment, amusement, recreation, including membership dues for any club organized for business, pleasure, recreation, or social purposes, or also facility or a portion of a facility used in connection with any of the above. So pretty much any of your entertainment expenses for business no longer used. This is any kind of business, not just C Corps. Keep that in mind. In addition to that, however, the meal deduction is still